Thanks for joining us on Power Lunch. This is Bloomberg Quint and I'm Meera Dugal. Let's get you the headlines. Indian equity benchmarks decline with Tata Motors leading the losers set after JLR announces a 2-week plant shutdown as global demand slackens. Rupee reverses early gains to fall back below the 74 to the dollar mark, the currency trading at all-time lows. Portfolio managers saw the worst drought of the year in September with an average loss of 10%. The IMF cuts global growth forecast as trade wars take a turn. And WhatsApp says it has set up a new system to store payment-related data locally in India in compliance with RBI regulations, paving the way perhaps for the launch of the WhatsApp payment service. Coming up on the show, a couple of voices. We'll do a status check on the currency markets with Sejal Gupta of Edelweiss. NS Venkatesh spoke to us earlier on the fund flow data for the month of September. We'll get you his voice, and Timothy Moore of Goldman Sachs on the India view. All right, all that coming up, but first let's take a look at the markets. Yatin Mota is here with us. Yatin.
Well, if you look at the market, it has been, on a slightly weakish note today. If you look at the advance decline ratio also, we have the 21 advances coming to 29 declines on the market. So clearly, we have two stocks gaining for every 3 declining. What's moving trade is, the private financiers again. We have Yes Bank, which has gained almost 4%, HDFC and Vedanta, especially after the fall we saw yesterday, is bouncing back in trade. Apart from that, Adani Ports and Z remain one of the top gainers, on the market today. Of course, Tata Motors is in focus. That stock dipped as low as 20% in trade, trading at levels lowest since 2011 January. And, clearly we have the company which is getting impacted because of slowing JLR sales in China as well as in Europe. Not only that, the company has announced a production cut for 2 weeks at the UK plant. So not good in terms of earnings and analyst forecast when it comes to JLR moving forward. Apart from that, another Tata entity, Titan, is down nearly 6% in trade on good volumes. Almost 43 lakh shares traded on the National Stock Exchange. And not only that, Eicher Motors is down 5%. Below its 52-week lows. So we have Eicher Motors trading at multi-year level lows. So not good as far as the auto pack is concerned. And similar is the case with Maruti Suzuki, which has lost almost 200 rupees in trade. So be it autos and the rate sensitives, clearly the market has been in selling mode in all of these names.
All right, Yatin, thanks so much. That's the equity market check. In the currency markets, rupee is once again hitting near all-time lows. Sajal Gupta, head of Forex and rates at Edelweiss Securities, joins us on the phone. Good afternoon to you. Let me first ask you about what's been happening in trade today. We've seen a fair amount of weakness resume.
Yeah, I think rupee was a bit strong in the morning. We had seen levels of around 73.90. But then gradually buying emerged, and we are now at the weakest point of the day, trading at around 74.20.
Okay. At this point in time, it does look like it's largely sort of dollar index driven, because I think the dollar index also showed some strength, which would have led to weakness in the afternoon trade.
See, I think at daily level, we in some levels to go weak. I think earlier it was crude, so when crude went to 84, 86, we weakened at a faster pace. Now crude, I think, again cooled off to 84, we didn't appreciate. So each day we find that maybe yesterday we were looking at Chinese currency wherein there was some weakness in the CNY and we weakened. And I would exactly make it that it was primarily weakening due to dollar index strengthening. So I think we can look at various reasons in the market. And obviously equities are not doing that well today. So I think that is another concern for currency weakness now. And I think the major backdrop is that since on the RBI monetary policy, they've clarified that it is primarily not the stated objective. So I think market is guessing that whose objective is to control and let support to the currency market.
Yeah, sure. That's the bigger backdrop for sure. Sajal, I'm keen to understand what is the structure in the market, in the sense, are we seeing exporters hold off on bringing back dollars? Are we seeing, for the want of a better word, panic hedging from importers? What's the nature of the market right now?
So primarily, clearly, as you said, no exporter is willing to sell or hedge at these markets because they are looking at higher levels on rupee, because that's what the trend is. Unless until rupee goes down, maybe 1 rupee in a trade, or maybe it goes below 73.50 or 73, then maybe exporters would look to hedge. But as of now, they are making merry in terms of that each day is a new low on rupee, and it adds to their realization. So nobody is hedging from the exporters, and obviously importers are hedging every bit of it. Whenever they have an exposure, they will come and hedge, because each day it depreciates by maybe 20-30 paisa every day. So anybody who is waiting on sidelines to hedge as an importer loses on the second day.
Yeah. Yeah. Okay. I mean, it's a slightly futile question, but nevertheless, is there any sense of, targets to watch or technical levels to watch on the currency here?
Yeah, as you yourself said, it's almost futile now. So we are looking at 75, that if it stops there. So, and again, you're hoping against hope. If the writing on the wall is clear that there is no concern in the markets from, in a sense, nobody is recognizing this as a problem. In a sense, both government and RBI are saying that there is no concern on rupee, and we are probably in line with emerging market currencies. So then I think more worry would be at higher levels and not at current levels. So we are waiting for higher levels.
All right, Sajal, thanks so much for joining us. Appreciate you taking the time to speak to us. That's the currency. The weakness, not at all surprising, is continuing. 74.20, as Sajal pointed out. The backdrop to this is the message that has gone out from the RBI policy that they are unlikely to step in a big way to defend it from a rate standpoint. Of course, they'll continue to do their regular selling from reserves as and when required. But the message that they will not be defending any levels came through very loudly and clearly. Now, the rupee's fall is hurting a small section of corporate India that still hasn't hedged its overseas borrowings. As the rupee's tumble worsens and a wall of debt comes due, not sure it's correct to call it a wall of debt, but nevertheless, debt coming due will have some amount of negative impact. Anurag Joshi of Bloomberg News joins us. Anurag, there is improved percentage of hedging, but still not entirely complete.
Yeah, still not entirely complete. It is true that, companies are becoming more compliant in hedging their forex exposure, given the fact that, some of them have burnt their fingers in the past, and there have been some very nasty lessons they had to take in the past. So now you have a considerable amount of hedging, but there is a good amount of exposure which is still unhedged. There are companies, which enjoy a natural hedge, like, in technology, and you have exporters in gems and jewelry and pharmaceutical. They have a natural hedge to, their dollar exposures. But there are, and also it is true that, you have refiners which borrow huge amount of dollars from overseas, and they are fairly hedged. But there are many importers that, have left their exposures unhedged, and that are very vulnerable to, any further volatility and any further depreciation in the rupee.
All right, Anurag, thanks so much. That definitely is something that needs to be watched out for. The other big story that's been playing out since yesterday, 2.3 lakh crore was pulled out of mutual funds in the month of September, and it was largely from money market schemes, including liquid funds, most importantly. Companies use this to park surplus cash for short-term purposes. So it looks like, some liquidity tightness and the string of defaults from the IL&FS could have caused redemption pressure. But let's go across to Jayesh for a sense of what the numbers look like. Jayesh, just run us through the data.
So it's a combination of factors that has played out this month, which is the quarter end, also the advance tax payment, and the redemption pressure on account of the IL&FS issue. Let's first have a look at the total inflow-outflow numbers that we got. So that's the trend for the year so far on a total basis. What we are actually seeing is a low of about 2,30,000 odd crores that has moved out of the market. Now there is some positive and some negative as far as this 2,30,000 outflow is concerned. Over the next two slides, we will get you those details as well. If you have a look at the negative, which came in actually from the liquid or money market front, where we saw an outflow of about 2,11,000 crores. Now this was the biggest outflow number that we saw in at least a decade since April 2007. But on the other hand, the positive that came out of this was that there was net inflow rise in equity flows. So equities from 8,375 jumped 1/3 to about 11,000 odd crores. And you see that since the month of May, we had been on a declining declining trend. So that has reversed for this month. At least we have seen snapping of the 4-month decline that we saw as far as the equity fund flows are concerned. Now, if you look at the total AUM picture, that has in fact declined pretty much in line with what the market did, from 25 lakh crores to about 22.04 lakh crores, given that the market itself, or the Nifty index itself, saw a 6.5% cut for the month of September. So, this is also pretty much in line. And for the equities AUM as well, if you have a look at that one, from 8 lakh crores to 7.5 lakh crores, that has also seen a dip in line with what the market dip showed. So, in line with this, we also spoke with the CEO of AMFI, Mr. N.S. Venkatesh, listening to what he had to say on these numbers.
Equity numbers have shown a positive trend compared even to the last month. It has grown a little bit. It is roughly around 12,000 crore if what we call as equity IL&FS balance all put together. I would say that one is the SIP flows which is coming in, the retail flows that is coming in. The retail flows has been steady. I would put it like maybe the market is slowly maturing, the investors are maturing, and they are not moving away from the equity market at this particular point of time. They believe that this correction, whatever has happened in the equity markets, is temporary. So they believe that this is the right time for them to continue investing into the equity market. I agree with you, the markets have been totally volatile during the last month, and it was a good number to have.
While it was very encouraging to see the equity number, but on the other hand, we had a huge drawdown in the liquid space, which I believe saw an outflow of over 2 lakh crores. Now, normally, it would not be concerning because this is a general phenomenon that we have seen during the quarter end due to advance tax payment. But this time, the number is exceptionally large. What factors do you think went into such a big drawdown in the liquid space?
No, I believe it's mainly the liquid funds are mainly a wholesale market, in the sense that it is invested by the corporates and the banks themselves, the bank treasuries and corporate treasuries. So definitely one is the drawing down for the advance tax purposes and capital adequacy purposes for the banking sector as a whole. So I think that is one thing which had happened. The second thing is the tightness in the market, liquidity tightness in the market, exacerbated by maybe they thinking that the monetary policy is down around the corner, so the interest rate hikes could be there, so they do not want to take any mark-to-market losses either in the debt funds. Liquid funds, it may be very, very minimal, but in the debt funds there could be large mark-to-market losses which could come up if, let us say, the rates are hiked. So I think it's a combination of those factors, plus the little bit of the whatever unfortunate events happening of some defaults happening into the system. I think that has also put more pressure onto the corporate treasuries and the bank treasuries to pull out the money. So the normal trend would have been, say, a lakh of crores could have gone out for the quarter end effect, but I think it has doubled during this period because of all these factors put into together.
So it's largely a one-time impact, or do you see continuation of this trend?
I believe that this will be a one-time impact. The liquid funds will definitely be a one-time impact for the simple reason that liquid generally is, let us say, an overnight plus at least a 50 basis point sort of a spread is what the corporate is getting in. So to that much extent, I think he will come back to the liquid and money market funds that are there. On the debt, he will again reassess what is happening into the situation. One from the rate angle, and another one is from the credit sort of defaults which had happened. So he would like to reassess what is the credit default, the nature of the credit default, and whether there could be more defaults on the way, and then only he will come back into the debt market. So I think liquid, we will see the money flowing back much more faster. The debt will take a little bit of a time.
You also spoke about very robust SIP book. Can you give us a sense of, or a ballpark number of what SIP book value can we expect this time around as well? Because that, I believe, will come out in due course of time. What's your rough assessment of what that number could be?
The rough assessment that we have made is somewhere around 7,700 crores, which is still higher than last month's number of somewhere around 7,600 crores. So around 100 and odd crores it has gone up. So that's the rough assessment that we have made. opening of accounts are also more or less steady at over 10 lakh folios that are being opened in SIP month on month. So to that much extent, I think we are doing better. Already from April to September, if you are taking that half year, if you are taking for the SIP inflows, roughly around 7,000 crores if you take as an average per month, roughly around 40 to 43,000 crores has already come into the SIP route in building up the EUM. Compare that with, let us say, the last year from 1st April 2017 to 31st March 2018. There you will actually see that the SIP numbers are somewhere around 60 odd thousand crores. So we actually see it to cross the 80,000 crore in this year.
Just a brief point on these liquid fund flows. It's a little bit of mystery as to what was going on in liquid funds both in August and in September. I think as Jayesh highlighted in his data, there was a large inflow of 1.7 lakh crore into liquid funds in the month of August, and then there was a 2.1 lakh crore outflow. Now the question worth asking is why did that not really reflect in rates, particularly in August when all of this money comes in? Remember, when money comes into liquid funds, it gets put into short-term instruments. So we've got some short-term rates on the screen for you. As this money came in and got deployed, why did rates not come off? You saw an increase in short-term rates in the month of September, but that seemed to be more linked to what happened around IL&FS, at least the timing of it was. So, you know, if a large chunk of money came into liquid funds and then went out from liquid funds, why is it not reflected in the short-term money market rates? And also, you know, what is the genesis of that money? Where did it come from? Where did it go? So I think the mutual fund data not entirely explained yet. But let's move on. 2018 has been a tough year for most market participants, and portfolio managers have clearly not had it easy. September in particular was the toughest of them all. Sajit Mangat is joining us for more. Sajit, how bad was it last month for these fund managers?
If you go by mutual funds, it was a carnage at the mutual funds, because you saw a lot of negative returns coming from many of the schemes. But the same was there for the portfolio managers, which account for nearly 98,000 crores in equity assets. That's nearly $13 billion in equity assets they have been doing. And we took into account 50 portfolio managers, which nearly account of 85% of the entire AUM. And the average, the net negative return was around 10% for the entire class of investors, which is the highest in this calendar year, because so far they've been been hit by only mid caps. Now the financials were hit in financial, especially NBFCs were hit in September. So many of the portfolio managers which were very aggressive on NBFCs, they took a huge hit on the returns, and that's the reason why we're seeing that 10% of negative return coming for portfolio manager. On the year to date, they're still negative at 8.3%, and for the quarter they are negative nearly 3.7%. So overall, it has been a negative return month for 50 portfolio managers that handle nearly more than a lakh and a half investors and $13 billion in assets.
All right, Sajit, not pretty there. You can go to bloombergquint.com and read more details there. Now, the funds have taken a hit because of IL&FS, but banks may not immediately reclassify their exposure, at least not in the September quarter. They should, but they're unlikely to. Vishnath Nair is joining us with details he's picked up from bankers. Vishnath, what's going on?
So your point about they should and they're unlikely to is fair. But what bankers seem to suggest is that this is the first time ever that they've seen a AAA rated company suddenly flow into default and get a D-rating in a matter of weeks. And they're unsure as to how exactly they should treat the loan exposures. Now, as far as the bond bit goes, that's obvious that once the default happens, then automatically you take the mark-to-market hit and get on with it. But then on the loan side, they're saying since the default first initially happened at the end of July and then in the first week of August. So then by the time those defaults turn into NPAs, it will be sometime in October, which is when the 90-day mark comes. So they're going to wait till that point in time unless the RBI steps in and says something. But since the September quarter is already over and most of the accounting is already closed, so they don't see any kind of impact coming into the September quarter. But they believe that since it has already been established that the company has no liquidity and it is going to be unable to repay any of the debt, eventually this hit will come in the December quarter. Remember that the total debt obligations for IL&FS, the entire group, is close to 91,000 crore. Of that, bank loans constitute nearly 50,000 crore. and the remaining is bonds. We're not entirely sure how much of that is from banks. But yeah, but essentially on this 50,000 crore loan book, that is something that we're going to see next in December. Hopefully by the time there's some kind of a restructuring plan in place. In any case, the newly constituted board is supposed to come up with a plan by the end of October. So if that is implemented in time, then maybe some of the provisioning hit can be controlled, but there's definitely going to be hit in December.
All right, Vishna, thanks so much for that. That's IL&FS in banks. Oil marketing companies have been the center of all the action last few months, while the past few days have been about the government asking them to absorb a portion of the cost. There were no such diktats in the second quarter, which means that fuel retailers should be able to protect their marketing margins, at least in the quarter, which will report now. Somit is joining us with the details. Somit.
So if you see in the second quarter of financial year 2019, the fuel prices were rising in tandem with the global Brent crude prices. Now, Brent crude was up around 10% in the second quarter of financial year 2019, while the retail petrol and diesel prices were higher by close to 11%. Now, this rise helped the oil marketing companies to maintain their gross marketing margins. Now, if you see in the second quarter, the OMCs earned marginally higher and a stable gross marketing margin of 2.2 rupees and 1.6 rupees on sale of every liter of petrol and diesel. However, the number was lower than the earlier highs of 3 rupees per liter, and that was because of this rising crude prices and a weaker rupee. Now, the higher crude prices. Now, generally, whenever crude averages higher compared to last quarter, the oil marketing companies tend to report an inventory gain. Now, that is because they have an inventory gain and that sell-off happens later, and that's the reason why they see an inventory gain. But if you see in the second quarter, the crude prices averaged around $75.89 per barrel as against $74.97 per barrel, which means that there would be an inventory gain, but the amount would be lower compared to last quarter, where the oil marketing companies had an inventory gain of close to 12,000 crore rupees, because crude averaged around 12% higher in that quarter. Now, if you see the crude price chart also, you can see clearly in the second quarter how for the first 45 days crude was averaging lower, and for the next 45 days of the second quarter, the crude prices were higher, and that's the reason crude averaged around $75.89. Now, the refining business, if you see the gross refining margins, now that remained largely stable for the oil marketing companies. The Singapore gross refining margin, that is the Asian benchmark, averaged around $6 per barrel, $6.1 per barrel as against $6 per barrel in the last quarter, and that was because of the rising crude prices, which kept the prices of petroleum products under check. Now, gross refining margins define a refiner's earning on processing every barrel of crude, and a stable gross refining margin means that there won't be any surprises from the oil marketing companies in that segment also. Lastly, one dampener that could be the weaker rupee. Now, for an oil marketing company, crude is the major raw material which is purchased using the US dollars, which means that a weaker rupee, they need to shell out more for purchasing these barrels of crude. Now, in the past, we have seen oil marketing companies report foreign exchange loss of profit in tandem with the rupee movement. However, the amount depends on how much they pass it on to the consumers. Now, in first quarter, they were not able to pass it on to the consumers, and that's the reason they reported a foreign exchange loss of close to 3,000 crore rupees. However, in the second quarter, they were able to take price hike and pass on this weaker rupee cost to the consumers. So the amount would be comparatively lower to the amount that we had seen in the June quarter ending.
All right, Samit, thanks so much for that. The Supreme Court has decided to set a limit on Petcoke imports by the aluminium industry. A two-judge bench has also added that Petcoke can only be used as feedstock and not fuel. Upmanyu Trivedi of Bloomberg News, who was in the court, joining us with the details. Upmanyu, what can you tell us?
Yeah, the court has imposed fresh restrictions on the import of petroleum coke by aluminium industry and calciners. We can recall that in July, Supreme Court had banned import of petroleum coke for use as a fuel. But the court had exempted certain industries which use petcoke as a feedstock and not as fuel. Those were cement industries, lime kiln, and gasification industries. Now, in this fresh round of restrictions, aluminium industry has been allowed to import only 0.5 million ton per annum of petroleum coke, and calciners will be allowed to import 1.4 million ton of petroleum coke from abroad. And apart from these two industries, the court has set a deadline of 3 weeks for EPCA, which is the court-appointed committee, to quantify the requirements for steel industry. And after 3 weeks, the court will decide what should be the amount of petcoke that steel industry should be allowed to import.
All right, Manu, thanks so much for that. JSW Steel, which has put in a joint bid for new metal with SR Steel, is seeking legal opinion to see if it can put in a separate bid for the company. JSW was barred from bidding in the second round as it had not participated in the initial offer for the steel giant. Joint Managing Director Shishagri Rao spoke to Bhanvi Arora. Listen to what he had to say.
Depends on how the view of the resolution professional and COC in the light of Supreme Court judgment. So if they are open to have any fresh bids, then we will definitely look at it.
And what are the expansion plans of JSW Steel for this financial year?
No, we are today 18 million ton. We have planned in the next 2 years' time to expand to 25 million ton. We are spending over 40,000 crores of rupees. So we will become 25 million ton, which is 40% growth over the current capacity.
There is the government is mulling import duty hike on certain steel products, and there is rupee volatility. So considering all these factors, how do you see steel demand in the future?
Steel demand is quite strong, but we are definitely worried about growing imports into India. When all other countries have taken measures to restrict the imports, that is looking for new markets. So we are seeing increasing imports into India and falling exports. So in that context, there is a need to make the trade remedial actions imposed by the Government of India more effective. That's why some relook is required. So we have been representing to the government. We are hopeful that they will take appropriate action.
WhatsApp has set up payments-related data storage system in India. The importance of that statement coming out from WhatsApp this morning is that it could finally pave the way for the launch of WhatsApp Pay, which was eagerly awaited. Nishant is joining us with the statement issued by the company and its implications. Nishant.
Well, right, Ira. So just days before the October 15 deadline by RBI, which asked them to, all system indicators should ensure that, all the payments related data should be stored locally only in India. Now, WhatsApp had issued a statement saying that they have built a system that stores payments related data locally. Now, the statement doesn't really specify that the data will only be stored in India or not. Now, but it's a right step in the right direction, given WhatsApp has been waiting to roll out its payments services platform in the countries. It's been more than a month's delay now, and it's already been used about close to about 1 million users in the countries in the beta testing mode. Localization is one of data localization. Interesting to highlight that data localization is also one of the key highlight which found mention in both draft e-commerce policy and also in the draft data protection bill as well. We'll see. We haven't heard from any timeline from WhatsApp about when they look to for the official rollout, but this has been one of the key bottleneck for WhatsApp for its payment infrastructure.
All right, Nishant, thanks so much for flagging off that story. Google is shutting down its long-shunned Plus social network. This follows a technical glitch discovered in March that could have exposed personal information of more than 500,000 people. Bloomberg News reports.
Google decided in January of this year, so just the beginning of the year, to do a very extensive security and privacy review. They looked at all their APIs, so those are the things that allow developers to request access to your information when you get one of those notifications that says, can app X, look at your contact information. They reviewed all of those across their platform, and they found what they call a software bug, where developers could see some of the information about people, such as your name, contact information, address. None of the private messages that you would have been sending on Google+, if you were sending any of those, would have been exposed. But still, it's some serious personal information that was out there. They decided at that point, right when they found it, they fixed the bug, but they didn't talk about it. And the reason from their point of view is that they found no evidence that it had actually gotten out, that anyone had actually used this insecurity to steal data. And so they decided, in the context of Facebook sort of taking this lashing, it was right around the time where Mark Zuckerberg was preparing to go up to Congress to face his accusers there. They decided to just not talk about this. And the Wall Street Journal, which originally reported this story, cites their sources that say Google specifically made this decision because of the political scenario they were in.
The International Monetary Fund retained its growth forecast for India in the current financial year and cut it marginally for the next fiscal. The IMF cited higher crude prices and tightening of global financial conditions for the revision. In its latest World Economic Outlook, the IMF said that India will grow at 7.3% this year and 7.4% next year. IMF's January forecast had pegged FY20 growth at 7.5%. However, India would remain the fastest growing economy, well ahead of China. That is forecast to grow at 6.6% and 6.2% in 2018 and 2019 respectively. For the world economy as a whole, the IMF projects an expansion of 3.7% this year and next year, down from 3.9% predicted 3 months ago. The IMF blames escalating trade tensions and stress emerging markets for the plateauing of growth. The change in global and domestic conditions has meant that the risk-reward in markets like India is no longer favorable. That's according to Timothy Moe of Goldman Sachs. He cites elevated valuations for downgrading India to market weight. In an interview with Bloomberg Asia, Moe says he expects the Fed to hike rates 4 times in 2019, while the markets are discounting only 2. Listen in.
We think the market's actually discounting pretty significantly a hike in the fourth quarter, so that's probably not too much of a surprise. What is going to be more challenging is our more hawkish view of Fed policy in 2019. Our U.S. economists continue to look for 4 hikes next year. The market's discounting 1 or 2, and so there's a gap between what we think will take place versus what the market's discounting, and I think that'll be more of a challenge as we go into 2019. Additionally, as you've said, we are likely to see evidence, really for the first time since the global financial crisis ended, that the combined balance sheet of the G3 central banks, the Fed, the ECB, and the Bank of Japan, those balance sheets are likely to turn slightly negative into Q2 and Q3 next year. And so, as you said, the tide is gradually turning from QE to QT, or quantitative tightening. And I think that'll be another headwind for markets as we go into 2019. So our composite view is that equity returns from here are likely to be much more subdued going forward into 2019 and probably beyond, but that in the fourth quarter we could see somewhat of a tactical bounce for the reasons I was mentioning.
If you look at Asia, Tim, can you pick out for us some of the emerging markets in this part of the world that might be more buffered when it comes to trade? And, you know, putting aside obviously the dollar is always a key component of how emerging markets go, ones that don't have the idiosyncratic problems that would cause, you know, massive fundamental issues?
Well, Heidi, it's a great question. Let me just answer that in a couple of parts. First of all, just to put our views on the table, we also think that both the performance spread and the valuation spread between the U.S. and emerging markets is quite stretched. Just parenthetically, if you look at sort of a rolling chart of 6-month relative performance between the U.S. and EM or between Asia, that rubber band is really stretched quite wide right now. So we think some sort of a bounce back in relative performance is due. So that'd be the first point I'd make. Second, obviously, the reason why things have gotten this stretch is because of many of the challenges that we've been speaking about in this and the previous segment. In particular, I think the heightened concern over the trade conflict between the U.S. and China. And that leads to the third point, which is that unfortunately the parts of Asia which look the most interesting from a valuation standpoint are the ones that are in the crosshairs of these various concerns, aka China. I mean, China, particularly after the sell down that we've seen in the past 5 days, is trading in round numbers, both the offshore stocks as well as the onshore stocks. We're trading at about 10 times forward earnings. Our measures of risk appetite are sold down quite significantly. And if we're right about earnings roughly holding in, as I mentioned the numbers before, sort of at the low teens, then that suggests that we have a pretty interesting risk-reward environment for China. Now, obviously, it's hard to convince people to go back into that market right now, given all the uncertainty over trade. So that's one of the reasons why we changed our view on Singapore to overweight. We think that Singapore is relatively less exposed to the concerns over trade. The market has performed weakly, and on a valuation standpoint, it's one of the cheaper ones in Asia. And additionally, if you look at the key industries, there are a number of industries like banks, property, and offshore industrials that are beneficiaries of the rising interest rate environment, and also the increase in oil prices. So we think on a relative basis that the prospects for Singapore here look more encouraging. And as I said, it's less exposed to concerns about the dollar and about trade. So that would be sort of where our views are. If I could just add one thing, we did lower our view on India about 3 weeks back from a long-standing overweight, where we've been overweight for about 5 years, down to market weight. Now, to your question, India is one of the least affected directly by trade, but the market had outperformed very significantly and was trading at very elevated valuations, and for a few other reasons that are specific to India in terms of some slowing in the short-term macro data as well as the political cycle there, we felt that the risk-reward was no longer that attractive, and we took our view down.
All right, that's a wrap on this edition of Power Lunch. Thanks for watching. Stay tuned to Bloomberg Quint.